Dr. Faber, you are a known and distinct bear on the dollar. Is it still, do you think, going to hell in a handbasket?
Yeah, it will be worthless one day, that I'm fairly sure.
Okay.
But between now and then, obviously, you can have wide fluctuations, and the other currencies may not be much better. So I think that an investor, he should have some positions in physical gold and silver and in hard assets like real estate, land, and some other commodities.
Okay, tell you what, for a high net worth individual, and among your investors would be some very wealthy families, your average typical portfolio in gold, in physical property, how much?
Well, I think well-to-do families, they will have real estate, and they will not have me manage their real estate holdings. So they could have, say, assets of $1 billion, and maybe 800 million would be real estate and real estate related, and then they have maybe a stock portfolio of 200 million, and that maybe...
So 80% is in real estate?
Well, I think in Asian wealth and also in European wealth, there's a huge quantity that is tied into real estate, yes.
Is that a good
It would
thing?
be unusual for a family to have $1 billion all in equities and bonds and no real estate. Because most of the well-to-do people in this world, except the new economy wealth, like the Google's guys, they made their money out of, say, technology. But if you look at old families that are very well-to-do, most of them, they are well-to-do because they had real estate.
But what would you recommend? What would you
curious.
recommend as a distribution, which I think was Martin's?
Well, I tell you, they have real estate and they're very well-to-do because they didn't do anything more stupid with their money. So it was always tied in real estate, and they didn't borrow against it because they're well-to-do people.
So the thing is, I mean, on the one hand, you could view it as a very conservative way to manage your money. On the other hand, though, I mean, something like real estate land, they're not making any more of it.
Let's put it this way. If we have children, and our children are not that smart financially and investment-wise, and I mean, you know, people are different in the world. There's some artists and some people that are good, like
With
the
numbers.
Goldman Sachs people, at making money. And so let's assume our children don't know much about money. I think to have them have money parked in real estate is not a bad way to preserve wealth.
Given your scenario that we talked about earlier in the program, you would upweight equity, surely. I mean, if you were 80-20 split hard assets, equities, you would be, and you'd concentrate a lot of them in the developing markets. I mean, in the break we talked a lot about Latin America and Brazil. You were there recently. You know, we go there frequently. Brazil, Mexico, Argentina managed to live with crisis.
The thing is, with Armageddon, with hyperinflation, with war, gold is heavy. You can still take it and run. Land can be all too easily confiscated over.
Yes, but if you have it spread out, if you have some real estate in Brazil and in Argentina and here in Asia, let's say you have real estate or equities here in Singapore. We have World War III. I think at the end of the war, Singapore will still be here because it will stay relatively neutral, and nobody has an interest to drop a bomb on the top of Singapore simply because it's politically, in the world's context, totally insignificant. Totally insignificant. So real estate here would be, say, an avenue, and also equities here, the companies here, you have world-class companies
What about
in
where
Singapore.
you're partially based? That is Hong Kong.
Well, I'm not so keen on Hong Kong real estate. I think it's relatively expensive compared to, say, real estate in Beijing and in Shanghai and so forth. But I think here in the north of Thailand, real estate would be, let's say, desirable.
Desirable, but you can't get title as a foreigner, though.
Well, depends. I think you can get, yes, reasonable safe title. Not as safe as, say, in Australia or New Zealand, but even there it's not 100% safe for the simple reason that you have essentially
but
the Aborigines.
Wouldn't you pay for that risk, though, not having a clean, pure title to land?
Well, my life
Emerging markets like
expectancy is no longer that high, but let's say for my children, maybe a different story.
Good enough.
If the title is in my wife's name, then it's 100% safe.
Okay, interesting stuff. Let's see here. We've got email starting to dribble in, so let's get to some of there. Rosie, where'd you tuck that one email? Under George. All right, I'll tell you what. There's George. Okay, George is asking this. If investors had followed Dr. Faber's view back in March of '09 in the Gloom, Boom, and Doom report, they would have missed out on the biggest rally in 70 years. This wrong call, this gentleman says, this is George writing from San Francisco, cost huge returns. If it's true that most returns in the market came in very short periods, and he was wrong about the market at this critical moment, why should we listen to him now? We respect you. Please help us understand.
Well, but precisely, I said starting the end of last year that you should accumulate shares, and on March 6th I was interviewed by your competitor Bloomberg. I said buy the share market. So I precisely said to be in the share market between March 6th and recently. Recently I've turned kind of neutral because I think that we're in a trading range. And a big move is coming, a huge move is coming in the dollar, in bonds and in equities. But I'm not yet sure clearly on which side it will be. It looked a week ago, as I said, as it was breaking down, but I didn't short the market at that time because I didn't feel that it was the right time to be short the market, and that failure to break would push the S&P and markets once again to new highs. In July.
Wasn't that rally that you referred to in March as a relief rally? It was really an Armageddon rally. We didn't have apocalypse now. We didn't have Armageddon.
Markets were priced for extinction at that stage,
and wasn't that really? We were just relieved that we didn't see the collapse. And now you said earlier, actually, maybe it's time to go away and wait until the first half's out of the way and come back in September and October and see what's happening then.
Yeah, I mean, personally, March to today, to beginning of June, June 11th, the market peaked out, S&P 956. We had a huge opportunity. We recommended resource shares. We had Newmont Mining doubling since December of last year until recently. Freeport McMoran went up more than 3 times, and so we had already a big rally. Now I think it's a time to just stand aside a little bit and look how the markets will move. I think a big move is coming, but I'd like to see really what will trigger the move. And what will happen is if the S&P moves up strongly, I explained this correlation before, US stock market strong, currency weak. US dollar strong, it signals tightening of global liquidity, asset markets weak.
Interesting. Okay, we'll come back and talk a lot more with Dr. Doom here, Marc Faber, and also our guest host, Sir Martin Sorrell, WPP Group.